Hey everyone, welcome back to the MHP Show podcast. I'm your host, Derek Vickers, and you guys know what we talk about on the MHP Show here every week. If it's not me running my mouth, I have someone else on here that gives you a little break from listening to me. But you guys know we're talking about mobile home parks, the game of mobile home parks, and just expanding, scaling, and managing and dealing with, the craziness that can come with that. So I have a special guest with me today, Mr. Jack Martin from 5210. Jack and I have been playing phone tag for about 3 months, but the podcast was now we're fully able to connect. Jack, welcome to the show.
Great to have you. It's been a little bit of a battle to connect, but here we are.
Yeah, for sure, man, and definitely glad that we're able to connect. I think when I was at Raise Fest and I met a broker. And I told him I did mobile home parks. And he's like, hey, you know Jack Martin? I'm like, no, I don't. And he gave me your number. And then we were kind of connecting back and forth, but it was just difficult for us to get together. I know you're a busy guy. We got a lot of stuff going on. But, anyways, glad to have you, man. So, what was kind of you know, how'd you get to mobile home parks?
My real estate journey started out in the land development. I was a general contractor, so I was buying land, subdividing, building spec homes, selling homes.
Mm,
And it's kind of interesting how the thin thread of life kind of weaves its way. A couple buddies and I used to play this game, Cash Flow, Robert Kiyosaki's game. Remember that?
yeah, yeah.
And the idea was, why are we playing this for fun? Well, let's play this for real. So we started buying rental properties, like individual single family. That turned into about 250 properties a year. We did about 2,000 single family properties. And
250 houses a year?
yeah, we were aggregating those. We didn't own
Wow.
them all. So, well, for a short period of time, we owned them all. But we were building a small rental portfolio in the background, but we were flipping most of those. So it was more of
Mm,
a wholesaler thing. Um, and then I got bored. You get burnt out in that game. So I started buying apartments. And I
mm,
thought that was going to be my final resting place for my career. Let's just go build a portfolio of 5,000 apartment units and build a retirement. And then I tripped over a mobile home park, literally. And once I saw the intrinsics of mobile home parks and really understood the stability the sidestepping the volatility and the cash flow that's consistent, I was all in. So exited that firm, started my own shop about 9 years ago now, and started buying mobile home parks.
wow. Wow. Yeah, I think it's interesting. Like I talked to a ton of people on this show, and like falling into the business is not an uncommon topic. Not an uncommon topic. Maybe somebody was buying something else. They bought a portfolio of like duplexes or something, like, oh, we got to take this mobile home park. And then they find out that they actually love the business. So what did you like about the business specifically?
Well, it seemed to me that the barrier to entry was a little bit more difficult than you'd imagine. So I like that. I was under the impression initially that there was a gap in the marketplace, where parks of, let's say, 50 lots or more were too big for the small operator, but they were too small for the institutional player. So it
Yeah.
seemed like there was that, 50 to 100 space opportunity where there was less competition. I like the idea that you could still outperform in tertiary markets. Another thing that probably wasn't receiving the same buy pressure as you see in primary and secondary markets. So those things were favorable. But I think the thing that stood out to me the most was when I went and looked back at 2008 through 2012, where we all saw like tremendous volatility and pain in commercial real estate in the markets that we were interested in. We couldn't find a single foreclosure in the mobile home park game.
Mm, mm,
So I think that the foundation of this thesis of mobile home parks is, when things get really difficult, do you stand to lose? Like, is there risk of loss of capital? And if so, what's the severity of the loss?
mm,
And what we did, or what we discovered in all of our research, was not only is the severity not there, we couldn't even find evidence of loss.
mm,
So that stood out to me more than anything else. I wanted to be in a position where, if you're going to dedicate your life to building a portfolio of real estate, and you're going to be honorable steward or responsible steward of investor capital, that comes along with that, you want to make sure that the rug can't be pulled out from under you.
Mm.
So favorable supply demand dynamics, a little difficult barrier to entry, and underneath that, like rock solid foundation of stability.
Yeah, yeah, and I agree with you, and I love the business for all the reasons that you said, and I just, like when I talk to investors that are new and they're used to apartment syndications. Our game is different. Like when they see some projections and things that we make, and I'm like, this is not apartments. Like these things are naturally like behind in rent. Like, you can't get 5% rent increases in apartments. Like it's more like 2% or 1%, maybe not even anything that I've seen this year. And so it's just, I think it's different than, than apartments are our business. And you know that, but how do you buy when you want to be a good fiduciary of someone's capital, obviously? Like, how do you buy? Because I see some guys, they're buying this stuff at 4 caps in hopes to make it an 8 cap. Like, I don't like that game, right? It's not interesting to me. I don't know if you do that, but I'd just be curious to how you buy.
Yeah, so that it's interesting. There's a lot of nuance that aims at the answer to that question. Part of it is what's your long-term strategy? So, if you kind of look at this industry, and this will be a long way to answer this question, there's really three players in the business. You have the institutional owners, and once institutions own something, we're never going to be a buyer for that, and you know that. They typically will never go for sale, or if they do, they trade among institutional buyers.
Right.
On the other end of the spectrum, there's the mom and pops that either they built the park originally, or their father or their grandfather built the park originally, and it's just been in the family for a long time. And then there's us in the middle, the professional owners who are taking underperforming assets and repositioning them and either holding those or putting them on the market on the backside and exiting. Typically, that trajectory has the consolidation finishing up where the institutions own everything, which is what happens to most asset classes.
Yep.
Now, while I say that, there's still the nuance is institutions don't buy 20 space mobile home parks. Institutions don't buy um, in locations that are urban or kind of out in, or excuse me, rural or out in the middle of nowhere. So there needs to be stability with respect to demand. Like those things are important. So, but what's great about this asset class is that there's so many different exit strategies or kind of like long range vision that's possible. And there's so many different acquisition strategies and then management strategies, which kind of dictate how you build your portfolio. So we started out buying parks in tertiary markets. That was the thesis. There's no pressure out there, so we can buy at an 8 cap and turn that into a 10 or a 12 cap. Um, and what we discovered was it's the difficulty to execute out there in small tertiary markets, like even as simple as I need some plumbing work done. There's
Mm.
only 4 plumbers.
Yep.
3 of them don't respond, and the one that does is booked until next year. So like those kind of things are present where if you go inner city primary market, there's 400 plumbers available, and you can actually get a really good one to show up next week. So
Yep.
some of those things, from an execution perspective, location really becomes the driver, especially if you're trying to build to scale.
Yep.
So, our experience in buying in smaller markets or tertiary markets, and sometimes even rural, kind of broken 2 star, 1.5 star product, we've shifted our strategy to more institutional quality assets, or at least assets that have institutional bones. So they could be institutional once you reposition them. Yeah, you're going to be paying a lower cap, but the exit cap is lower as well. So,
Sure. Yeah.
um, it really depends on your long term strategy. We started out with the intention to buy, reposition, exit, and there was terminal exit on everything that we purchased. Whereas today, we're looking at more of an indefinite hold
Mm.
as a tax strategy. So, like the maturity in this business, and as you know, it's a shrinking pool of properties.
Yep.
There will be a day when there are no more properties available to purchase, and I think that's probably we have a 10-year window probably. Could be more, but it seems like that's what the likely outcome will be. And then there's, how many new mobile home parks get built every year? 10
Yeah,
across
not
the
many.
country. It's really, really difficult to build new mobile home parks because you have to have the perfect blend of zoning, utility solutions, and demand.
Yep.
So, those three things lining up are so rare that there's just not a lot of new parks that get built. So the asset class is shrinking, or the pool of potential parks to acquire is shrinking. I mean, they knocked over like 8 mobile home parks within 20 miles of me, or 30 miles of where I am sitting right now, last year alone,
Wow.
to redevelop those into apartments or condos or some other use, because the land's worth more than the park, right? So if you
That's in
look at,
Phoenix? In
yeah,
Phoenix?
yeah, in Phoenix, there were a whole bunch of parks that got shut down
Mm.
and redeveloped last year. So you take all of those things into equation. Our view is, I want to buy 3-star assets, of good quality. Let's call it like when I'm done, there will be the nicest park of its kind in the neighborhood,
Mm.
and hold those long term for a tax strategy.
Yeah. Yeah. In long term, you mean like indefinitely. You're going to hold them.
Yeah, well, so there's a couple different plays here, and this is where the friction exists between the passive investor and the operator. So the passive investor wants to allocate their capital. They want to avoid, well, the larger check writers would like to avoid the taxes, both the recapture of depreciation and the capital gains. They would like to get their money back out of the deal and then keep the coupon forever. Like, that's their goal,
Yeah.
right? Now, maybe that's not the smaller check writer's goal, because they're still flipping their capital and they're trying to grow it. But larger check writers are more sensitive to tax savings, and then avoiding tax events in the future, and amassing a coupon, that they can just kind of rinse and repeat, so that they have cash flow that lasts for the rest of their life, and then when they pass away, that goes to their estate. The challenge in that becomes, as the operator, like, you have to exit in order to take the promote. So,
Yeah.
like, what motivates or what keeps those interests aligned? And so what we've done is just designed a strategy where we'll refinance at intervals, return capital, and then as you reach additional hurdles for the LPs, we are able to earn our way back to like an equal relationship where we're a 50-50 partner. So it does take a long time, and it's a patient game, but it allows everybody to win except for Uncle Sam.
Yeah. Yeah. And they don't, the Uncle Sam doesn't need to win. I mean,
Well, he
that's,
wins enough.
he wins enough. He wins enough. Like everything gets taxed and taxed and taxed and taxed and taxed.
Yeah.
Um, well, in your investor pool, like, do you have, when you say big, larger check writers, what do you mean? Like a million plus kind of guys?
Yeah, typically starts at about a 500,000 and up. What was interesting, because we did a little bit of a study um, about 2 years ago. So I started out just like everybody else starts out. If you're a new operator in the space, you have to build a track record before you can attract checks of substantial size. So you start out with friends and family money and 25 to $50,000 checks, and that's just how it begins. And then you build your track record and you prove that you're good at what you do, and you build all of your internal operations and your property management and all that kind of stuff, so that you could pull all the levers and continue to um, outperform your original projections. That's the game. So if you can do that, then you'll start to do it for a long period of time, report on time, give K1s on time, distribute on time, like all of that fun stuff. If you could do all of that, then you'll start to attract larger check writers. Um, that's what they're doing, is they're trying to allocate to this asset class with somebody that has a proven track record, and that they can trust. So the study was that about 25% of our investors, as a number of people, were writing checks of $50,000 or less, historically, like in our entire investor network. But only 4% of the capital came from that group.
Mm.
So it's a small group. And typically what we discovered is that those are the investors who want to get in and get out and get paid and get in and get out. Like they're trying to build their wealth. Um, and mobile home parks is not necessarily the best asset to do that with. It's still the best, or it's still solid for the fundamental reasons, protection from loss and lack of volatility and all those kind of things. But it's not a speed game, especially if you're buying assets that require infill. It takes some time to really, meaning, and you're being a responsible steward of your residents at the same time, so that you're carefully bringing those rental rates up to market, so that they can budget for it. I mean, this is still at the end of the day affordable housing, so your
Yeah.
success is equal to the a great relationship between management and residents. That still needs to be present. So it's not a speed game. This is a stable. It's kind of like the tortoise and the hare. This is the tortoise. It's every day we're moving the needle. Every year you're raising 5%. I mean, it keeps going, and it always keeps going towards the finish line, which is great. But what we discovered was that the kind of a psychological hurdle was at $250,000. So for investors, they start to think that, okay, I I'm writing a larger check when you get to 250. So we set our kind of minimums for that class of interests at 300, and it's interesting to see that that's where the battle takes place. So I kind of feel like your average large check writer is going to think the same way. Someone's
Yeah.
writing a $500,000 check or $1 million check or a $2 million check. They're all thinking similarly, and so we're trying to attract or put investors together that think the same, so that
Yeah.
when there's a vote at intervals, like we'll typically purchase an asset with the initial hold period of 7 years. At the end of that 7 year period, say, hey guys, we want to keep this for another 7 years. Who agrees? Well, if there's 15 investors in the deal, we'd like all 15 to agree.
Right.
We don't want 8 of them to say, nah, I'm out. Because that creates a challenge, right? So, but
Yeah.
if one or two decide that they need liquidity right there, that's just fine. The wherewithal among the 15 or the other 13 to solve for that, it's there. It's going to be there. Or you could provide liquidity through a refinance event right there.
Hmm. Yeah. Interesting. Yeah, I mean, look, I think it's a different mindset for, definitely your $50,000 investor up to that. I mean, I think it's like you said, everyone starts out, in the first one, you'll take whatever you can get, right,
Mhm.
to get the deal done. But I think as I've grown, I feel like, it's easier to deal with less LPs, obviously. And I would almost prefer larger check writers if I can. But we still accommodate, like our minimums are 100,000. What are your minimums on deals?
Yeah,
You
same.
said same.
Yeah.
Yeah,
No, I still think it's important to recognize that the folks that help you get where you're at still make sure to always allow a spot for them to participate on an ongoing
absolutely.
basis. But I think it deserves to be said that at the same time, when you're learning your business and you're just getting started, and you're only able to attract smaller checks, it's the same thing with the LP. When they start allocating to these different sponsors, I mean, their exposure is to the risk of the people. Yes, they're still exposed to the real estate. So, like, you understand that the real estate is good and the location is good and the upside is there, but will the sponsor execute? So, at the end of the day, the thing that matters more than anything else is the people that you choose to allocate to. So, if a newer investor is writing $50,000 checks, like he may be allocating to 10 sponsors, just trying to find out like who are the ones that I can trust to allocate more to in the future. But this, in the same fashion that as you grow your business, the LPs are also growing their wherewithal to invest.
Yep.
So you'll see those $50,000 checks grow into 100, to grow into 200, and that will happen over time. And I think that the most powerful piece in this, we haven't advertised for capital. We haven't had to. You keep getting up every day and do the right thing, the next right thing. Just every day, get up, do the next right thing. um, be a great steward of capital in every respect, but you would also do the same with your residents and the same with your staff and the same with your vendors. And like, if you'll just keep doing that, there's no question that a win is going to occur.
Yeah. Yeah, for sure. What do you do to be a great steward of capital on, I guess by deal and your management style? Like what are those things that you're like, this is what I have to do to be a good steward of capital? Does that make sense?
Yep. Yeah. So the obvious ones that most people would probably identify is going to um, be conservative in your underwriting. Leave room for a problem to arise. So because real estate, even though by design, hey, this is our plan, this is our strategy, it doesn't always go as planned.
Yeah.
There's things that the market will throw at you, the things that the economic volatility will throw at you. There's all kinds of dynamics that will come at you as you own this asset. So leave some. Nate, my business partner Nate, calls these cookies in the pantry. Leave
Mhm.
some cookies in the pantry so that when one of these things occur, you can outperform because there's room for that with these things that you didn't underwrite to. So, for example, you're purchasing a property that has 50 vacant lots. You think you can sell 25 homes a year. That's a 2-year project done. What if you can't? So, set this up to where year one expectation is no home sales at all. Year two is 10. Year three is 15. That kind of rolling forecast. If you can sell 25 in the first 2 years, great, you won. But you didn't put yourself in a position where you had to make it perform the way that you're advertising. So I think it starts with underwriting that has room for to overcome some kind of surprise.
Yeah.
It's difficult. I mean, we see so many parks that are amazing to look at, and the thesis is there, but yet everything would have to go perfect for it to achieve the yield expectation that LPs are seeking. So I think it starts with that. Um, Obviously, reporting on time, distributing on time, delivering K1s on time, like those things are kind of like they should be fundamentals in every business where you're being the steward of passive capital. So, but then there's some other things like be available. So it's
Yep.
difficult when you get, a couple hundred investors to be available, all the time. But design your business such that if an investor has an issue, you can solve for it. There's ways to do it where you can use third party. So we chose or we elected to use a third party administrator. I don't know if you're familiar with that.
Yep.
Um, and they handle most of our investor questions and issues. Hey, I want to transfer from my LLC or from my personal to my trust, and how do I do that? I couldn't figure out how to get my ACH set up. Who can help me with that? So when you have hundreds of investors coming at you with those kind of things, having a third party to help manage all of that so it gets handled expeditiously is pretty cool. Um, but yeah, it's just about being thoughtful around what potential risks are there, what could happen, and then solving for it in advance so that they don't happen.
Yep.
That doesn't mean that you still won't have COVID kind of events that throw a wrench at everything, and you can't deliver taxes on time. Like that those kind of things will be present. But I think if you've designed your business in such a fashion that you are expecting to solve for these things, then you'll be able to.
Yeah, yeah, for sure. And I think you and I think the same along those lines on communication and transparency. And we did a three-part portfolio deal last year, and I had a couple investors come in. It's their first time investing with me, and one guy said two things. He's like, Derek, like you got your K1s out before I even got my K1s out. And they were just so blown away by like they're in other syndications. And it blows my mind that they're like, I've been in other syndications for 2 years and I've gotten one email. I'm like, are you kidding me? I just don't even know what the thought process is behind that. And I can't even think with not being open and having at least quarterly communication with your guys. And I think it was just it was kind of a wake up call for me because it was just like, okay, I do this, and then they come in like, oh my god, you're going above and beyond. And I'm like, man, this is what someone should be doing if they're taking
Yeah,
their
but
hundred
Derek,
thousand
that's
dollars.
that's the thing that if you keep doing that thing, that's the thing that gets larger check writers excited. Like
Yeah,
knowing that you do those kind of things. It's likely that someone who's allocating passively to real estate with check sizes of, $500,000 or more, they're probably in a dozen syndications, and one of those operators is going to be late, at least one, right? It's just not going to be you. It's not going to be me. But I think that what deserves to be shared about that is that doesn't happen because you just decided in March that I'm going to deliver this year on time. That starts back in September, the previous year, getting all of your Q1, Q2, Q3 complete so that all you have remaining in January is Q4 and year end.
yep,
And then you're able to go back and forth with your admin team and your accountants in February and say and solve for all of the little things that need to be solved for. And then it's on their desk to go create K1s in the beginning of March. That starts way back in September the prior year. So people that aren't thoughtful in the way that they approach things are never going to be able to deliver on time because it's too late. If you start doing that in December or January, it's way too late.
yeah, yeah. I mean, we it's a pretty big deal around our company to like that is an important thing. I think I watched a podcast one time with a large operator, a multifamily operator. I mean, they have $1 billion, and I'm like, dude, if they can get their K1s out before March 15th, we can get ours out before then.
Mhm.
I don't give a shit how complicated it is, right? Like we're gonna do that. Um, and so, yeah, I think it's interesting. I wanted to ask you because this is always interesting. What was your first capital raise, and what was it like?
Okay, so we bought $2.5 million. Well, it's actually I think $2.25 million asset as our first park. The capital raise was 750 grand. We had a 4 month escrow and then an ability to extend 30 days thereafter. So we had 5 months to raise it. And
Mm-hmm.
this is our first capital raise. And I still remember, now I had experience, I had done apartments and single family homes. So I had a little bit of a following and I had quite a bit of experience. So I start calling my investors. This is back when you actually called them. You didn't get on a podcast like this, right?
Yeah,
Um,
I still
and
call them
and
sometimes.
the response, oh yeah, I know, but like individually calling them and saying, hey, here's what I'm doing now. This is new. Um, would you like to invest? And most of the answers was, Jack, I really like you, but let's have you get some experience first. It's a new
Mm,
asset class. Get a couple of these under your belt, and then call me back. Right. So that was it. Was I think I made 1,100 phone calls to raise
mm,
that 750 grand. So it was a grind. It took all of 5 months. We were actually a little bit short at the end.
yeah,
So, we had to bridge that and then go continue to raise it and backfill it. That's how the first one was. So,
yeah.
but what's interesting is fast forward to today. I have a mentor, 75-year-old guy, really neat old guy. He's semi-retired. He was in the apartment business and they were doing billions. So this is that same person that you were talking about. He works 4 times a year at the quarterly meetings, and then he's present when they're buying something or when they're selling something, and that's it. That's his life now. He predicted, he said, Jack, 7 years from now, you'll have more money than you'll have deals.
Mm,
You'll have more demand to place capital than you'll be able to responsibly deploy it. Like that was his
mm,
prediction, and he was right. So today, when I get a deal in escrow, I just ask our investor network, whoever wants to see this first, raise your hand. We create a line kind of internally. Like if you've raised your hand, you get to see it first. Um, our deals close with that list of people every time. I'm not
yeah.
going out to the world to find more investors. So if you didn't raise your hand, you don't get to see it. Typically, they're fully subscribed in 72 hours.
Mm.
So quite a bit different than it was, 8.5 years ago when it took me 6 months to raise 750 grand.
Yeah, yeah, and I think it's like like a capital raising rite of passage because it's like I feel like it's the same story. It's the same story on mine. It's like you're grinding away. You don't even actually get the same thing happened to me. I didn't get to the full amount, so I had to bridge that and then raise the rest of the capital afterwards. But it was a grind. You know, you're making calls, you're calling everybody, you're sending emails. But I think I don't know. I just think it's a rite of passage or something spiritual in your first capital raise that you got to go through this grindiness to get it done. And then I remember like the second one, it was like we sent an email out to like one email and then boom, we had it all. So like it's um it's interesting how it evolves.
Yeah, and I
Yeah.
think that it depends on the size of the deal too, because you don't know what you're capable of until you take it on.
Mm,
It's kind of like, and I think that's a little bit of the nature of who we are as humans, is that we're constantly seeking to challenge ourselves and see what we're capable of. If you just made a widget and you were successful, and then you spent the rest of your life making the same widget, it just seems like such a boring life with the lack of challenge and the lack of like reward that comes from overcoming challenge. So, our first raise was 750. I think our largest raise was like 9 million,
mm-hmm.
for a single acquisition. And, that one took 45 days. So that took some time. But that was kind of middle of our capital raising experience. And we were
Yeah.
doing funds back then. So
Yeah.
we don't do funds anymore. We do direct investments only,
Mm,
which is kind of opposite. Most people start out with direct investments, and then they mature and they start doing funds. We went the other direction. So, and it was kind of at the encouragement of the larger check writers that are in our network, that they were saying, "Hey, Jack, I want to be exposed to a single asset with its unique strategy, its own duration, stands on its own, alongside maybe a dozen other people who think like I do, so that we
mm-hmm.
can pursue that long term kind of legacy hold tax strategy." Um, and although it is a little bit more work for me because I have more properties to report on and that kind of thing, more individual reporting that I have to do, we really like it. It really kind of makes a clean strategy. There's no portfolio. I mean, if you build a portfolio of multiple parks, you might want to sell all but one of them. Well, how do you solve for that?
Yeah.
So it makes it really simple.
Mm. Yeah. Yeah, because we've done like we're doing a fund now because we've done a ton of individual syndications. And so we like, hey, we're going to do a fund now. But it's essentially like, because, and I was just talking about this on another podcast. I'm like, okay, we'll raise the capital and we've got a deal pipeline. I have a pretty thick pipeline. But then all the deals hit at once. So we're essentially doing the syndication for all the deals that are going to fill up the fund like that, anyways.
Yeah.
So, it's just kind of interesting how that works. We've been working on all these deals, and as soon as I'm like, all right, well, we're just going to do a fund here, boom, all the deals hit, and we're essentially like going. It's the same ball game again, but it's cool. And this is the first fund, so I'll let you know what I think of it. I like it generally. I feel like that we have gotten people that maybe only do 100,000 or doing 250, 300, 400.
Mhm.
Right? So we're getting larger checks. And our fund, like once I launched it, it wasn't a completely blind fund. I already had multiple assets that we had under contract. So I think it was a little bit different. And that would have been hard for me to do in the beginning, is start with doing that, especially
Oh
like a
yeah.
blind pool fund.
Yeah, yeah. It's interesting that there's pros and cons to the fund and the direct investment conversation. The pros to a fund is you can always be raising.
Yeah.
It's like, hey, this is what we're doing. Yeah, we have you know these parks in here. We're going to add more parks that are similar, so you can always be raising, and you can be leaning on the track record of your entire portfolio up to this point and the early track record of the seed assets that are in the fund. So it makes it easier for people to say, yes, I want exposure to that when you have room for me. Whereas individual syndications, the challenge that you have, especially early in your career, is that you have a finite amount of time to raise capital, and you really can't be raising capital because you don't have a deal to look at. There's nothing to look
Yeah.
at. You don't have docs to look at. You have nothing. You don't have a offering memorandum, whereas in a fund you do, because you're filling it with assets. So there's pros and cons to it, but as we've grown, I mean, I'm 52, so I'm kind of looking towards retirement. 65 is normal retirement. Then I got 13 years left, so I'd like to be in a position where we're not selling. The goal is to not sell. Our funds all had terminal exit. As those reach the terminal exit date, we'll exit those. But now I'm starting to kind of look towards aligning myself with LPs that want to ride, into retirement with me, and just
Mm.
let's pursue a long-term tax strategy where we can get our capital out of it and then keep the coupon indefinitely.
Yeah, for sure. Do you think that there's anything that I know from an LP perspective, like, do you think that there's questions that they ask that they worry about too much they shouldn't necessarily be worrying about? And then the opposite of that, is there questions that LPs looking in a syndication or fund that they should ask that they don't actually ask? Does that
Yeah,
make
great
sense?
question. Obviously, the maturity of the LP is going to have them ask different flavor questions. Um, Typically, when somebody is being a pest and asking way too many questions, that's just because they don't have clarity, or they
Sure.
haven't developed trust yet.
Yeah.
Again, we can circle back to most of the concerns that LPs will have are related to their lack of trusting you. So once they or you've earned their trust, then those concerns will probably go away. And this is again why it's so important to get the people right.
Yeah.
So you can get the real. I mean, you know that there are nefarious characters out there that could take the same real estate, the same price, the same operations team, and everything, and they could still figure out a way to take advantage of an LP.
Hmm.
That those people are out there. So it's a little bit of a dancing through a minefield. You're dating. You're trying to figure out, like, who can I this is a marriage. When LPs and GPs get together for a period of time, 7 years or 5 years or 10 years or however long you're intending to hold the asset, you're going to be tied together. So
Yeah.
it's really important to get that right. You wouldn't just marry somebody without dating.
Right.
You got to make
Right.
sure you get to
I
know
guess
them.
people do it, but
They do, I know. But I think on the other side, like some of the obtuse things that LPs probably don't ask. One of them would be, what happens if you die? Then
mm,
what, if you're like in my case, I have a partner. We're equal partners. He runs all the ops. I run capital raising and IR. And I got my hand in acquisitions every day as well. But what happens if he and I are flying to look at an asset and the plane crashes? Then what?
mm,
So the likely outcome to that would be um, a receiver would be put in place, and the receiver would wind down the assets and sell everything off, and then both the beneficiaries and the LPs would receive whatever their rightful reward was. Right. The challenge that you and I both know, because this is not a simple asset class. It's not a you can't approach it like you would approach most commercial real estate as a receiver.
yeah.
Positioning mobile home parks for optimal value on the back end requires intimate or deep level of experience with respect to operations of mobile home parks.
Yeah.
Even as simple as like how you position the P&L, and when you would um, or how you position it and when you would put it out to market. Like, wait until we get to this spot so that we can maximize value, particularly when the stewardship of that would be or the honorable stewardship of that would be to meet the expectations that were given by the deceased owner when he raised the capital in the first place. So, like, what's the plan if you die? Is there a successor GP that's already been chosen to step in, take your spot, position all the properties to sell, exit so that both the wives of the owners and the LPs can get their maximum value.
Hmm.
Like, have you done that? Like, most people don't even think about those kind of things.
Yeah.
Um, Key man life insurance. So, like, if there's a partnership, like if I lose Nate, like that's a big deal. If Nate loses me, that's a big deal. So, is there key man life insurance in place? Like, just some of those things that they're probably like of catastrophic nature. They're not thinking about those. So
Hmm.
that's kind of on the investment side or the sponsor side. Like there can be a really good quality sponsor who hasn't thought of that either
Yeah.
because they're young and they don't think they'll ever die.
Yeah.
Turns out we all
You're
die.
talking to me right now, aren't
Yeah,
you?
it turns
You're
out
talking
we
to
all
me
die.
right.
Yeah, so like the strategy for a successor GP is like this is not a simple thing. You choose a person that you trust that's also, you could choose me, I could choose you. Like like and trust the operator, and you know that they would step in and they would be honorable stewards, or they would wind it down in a way that was in the best interest of all parties involved.
Hmm.
And then the benefit that they get from that would be a portion of your GP benefit. So it doesn't become dilutive to the LPs. But
Right.
it's like, okay, if we pass away, I want to make sure that my wife and children are taken care of and that our LPs are taken care of. And I'm willing to give you, Derek, to do this for me, some reward as a piece of the GP so that it doesn't dilute the LPs. So that takes some thought. Takes an attorney to drop a letter, give it to like a neutral third party that would manage that. And what happens if I die? First thing is this guy calls that guy, says you're up, it's your turn to step in. And then if you have a large portfolio that's complex, like maybe it's not an individual, maybe that's a group of owners that like and trust.
Hmm.
So one of the things that I think is really powerful in this space, and it's unique, Derek. I used to be an apartment guy. I was a single family guy. It's a dog eat dog, shark fested waters, man. Everybody is looking to rise to the top and take over everybody else.
Yeah.
In the mobile home park business, and I don't know if the business attracts these kind of people or if these kind of people are attracted to this business, but it seems like very collaborative. People know and like each other. We help each other. So if you have some kind of challenge that you're experiencing, we can be a sounding board for each other and solve for those things. And there are a lot of really high quality individuals that are operators of mobile home parks that you could trust to
Yeah.
wind down your entire organization, so that your LPs could get their, and your wife and your children. So yeah, that's probably a little obtuse, but it's just one of those things that people don't often think about.
Yeah. Yeah, for sure. And that, I think that's, yeah, I mean, and even me, it's like, okay, yeah, like, what is that thought process, and what is that process if something like that happens? Because there is a chance of it happening. I mean, unfortunately, like you don't want to talk about it or think about it, but it is.
Yeah, well, it's obviously like we know life expectancy is older than your age.
Yeah,
I think that's a question that more seasoned LPs will ask. And it's not a deal killer if you haven't thought about it, but they'd like you to start thinking about it
for
and
sure.
solve for it. So, like that idea came to us from one of our LPs that said, Jack, what happens if you guys die? I
Hmm.
said, that's a great question. And so we hashed it out together, and that put me on the pathway to go solve for that. But I think that also exists, let's go back to that question about being responsible steward of capital and questions that LPs may not ask. Say you find a great mobile home park in an awesome location, fully occupied, or let's say it's got, less than 10% vacancy. So there's a little bit of infill, or it's fully occupied. And and it's in a market where let's say the median home values are like 200 grand, lot rent is like 350. It's one of those markets, right?
Hmm.
Like you and I both know you can't sell homes at scale in that market. You
No.
just, right? That's a long-term process of RTO conversions. Like that's what that is, right?
Yeah.
Okay, so you're buying this property, and it looks great because it only has 10 homes left to sell, and that's just 5 years worth of RTOs, and then it'll be 100% occupied. What happens if a tornado comes through and wipes out that park. Now you're in a position where you have 50% infill, 75, maybe 100% infill required. How do you
Mm,
solve for that when you only have 12 months of business replacement insurance? Can you get that done, clean it up, and get all the homes moved in and sold in 12 months? Yeah, probably not, right?
yeah.
But again, these are of catastrophic nature. So we looked at a park recently in Florida down in the Keys, fully occupied, looked like a great opportunity. But when you start to ask the question of what happens if a hurricane comes through, because it turns out they do come through Florida every year, right?
Occasionally.
Yeah, they do. So if it gets a direct hit and that park is empty, it's not just the same cleanup and infill project as you would have in the continental United States, because now you have one road in and one road out.
Yep.
So how are you going to solve for getting everything out and getting all these homes in when you're not the only one using that road? Because everybody that had experienced the catastrophe is trying to get stuff out and get stuff in.
Right.
So now, like, if you think you can do that in 24 to 36 months on the mainland, how long is it going to take you on an island? Right.
Yeah. Yeah.
So that's those kind of, I think, um, everything looks rosy until you start to look through the lens of worst case scenario. So I think that, being responsible both of the business and the operations, and then of the individual properties, looking through the lens, like I love this deal, or I love this operator, and I want to invest with them. But before I do, let's look through like worst case scenario. What if this happened? Would I
Mm,
still be in a good position? And if you've been thoughtful around analyzing that risk, yeah, it's probably like an obtuse, 1/10 of 1% possibility, but it's still a possibility. And I think that what you'll discover if you start to analyze those things is, yeah, they took a look at this. They did analyze that, or they have been thoughtful around that. That just kind of tells you who they are, the
sure.
kind of people that they are.
Yeah. Well, Jack, it's been great having you on, man. Is there anything you want to leave our listeners with before we get out of here?
Um, I'll share one other nugget of wisdom. So, my favorite book in that I think every real estate investor should read is called The Secret Life of Real Estate and Banking.
Hmm.
It's written by Philip J. Anderson, who's actually an Australian guy, but it is a book that it's boring if you're not a student of history, but we all know that history repeats itself.
Yeah.
So if you want to understand real estate cycles, read that book. It's like $45 on Amazon. Um, it goes back over the last 200 years of real estate cycles. Cycles repeat themselves because human nature repeats itself.
Mm.
Fear and greed is real.
Yeah.
The greed begins it all, and the fear crashes it all. So we will have this kind of tumultuous up and down thing, although over the course of time, it always does go in the right direction. The thesis behind mobile home parks is that when those cycles crash, you're not exposed. Well, you can sidestep exposure to the loss of capital right there. So, understanding that history will repeat itself causes you to sleep pretty doggone well at night when you know your business or your capital is exposed to this asset class.
Yeah. Yeah, for sure. I couldn't agree more. So, Jack, we appreciate you coming on the MHP show. It's been an awesome show. I mean, I think there was a lot of nuggets dropped here, especially from the capital raising side. I know a lot of our listeners have trouble with that and like have thoughts around some of that. So I thank you for sharing your words of wisdom on that. And thank you for everyone for watching the MHP show. Please like and subscribe. If you want information on our new fund, you can go to www.victorycapital.com and schedule an appointment with myself or my team. And we'd love to chat with you about what we are doing in Fund 1. And we will see you all next week. Peace.